Great. To my right, I introduce Arnaud Llinas. He heads the ETFs and indexing business for Lyxor Asset Management. Next to him, Christophe Boucher, head of quantitative research and strategy at ABN AMRO Investment Solutions. David Ganozzi, chief investment officer at Yomoni, a robo-advisor. And finally, Hortense Bioy of Morningstar, who heads the ETFs, where she's director of passive strategies and sustainability research for Europe. So welcome all. David, I wanted to start with you because you come from a slightly different perspective as the rest of the panelists, which is the robo-advisor perspective, a big user of ETFs. Where would you personally like to see the ETF industry going from here, and what innovations would you like to see happen?
Well, funnily, I would say that we are looking for very classic and very basic things from ETF providers. So I would say that the two most important criteria we are looking for are first the price, which is very important for the end investor, and secondly the quality of replication or the tracking error, the low tracking error. Since our business basically is to provide investment solution to end investor, retail investors in France, and we think that the best way to do so is first to define the right strategic asset allocation for them, depending on their project, depending on their risk aversion. And this is definitely the key element that will have very strong implication for the performances of their investments. So we are very careful about this, and we think we need to spend a lot of time on this question. And the second pillar of our approach, I would say, is definitely to use passive investment. It can be ETF or funds, but mostly ETFs, for two reasons. First, because they are cheap, and second, because they are extremely reliable compared to active investment. So this type of investment we don't expect them to provide very innovative approaches or very outperforming approaches. We are very happy with the passive approach, simply because this is a very reliable approach, and it's an approach in investment that will be superior to most of active investment in the long run. So we definitely believe that this is the best way for the retail investors to save money. So our responsibility is to help them choose the right ETFs, because it's a huge market. For retail investors, you talked already about the challenges for the industry, especially in France. We are starting from a very low base in terms of education and financial education. So ETFs are a great solution, but it has to be explained, and we have a lot of education to do about this, because people don't know ETFs, but they don't really know the equity market at all either. So the first thing is just to explain what the asset classes are, what equities are, what bonds are, how is it relevant to mix these different asset classes together to get the right portfolio. And then we have to explain to them why ETFs are important and very relevant for their investment. So I would say, but this is also a very French perspective. We are starting from a very low base compared to other markets, and probably the US, as was mentioned this morning. So we see our role as a robo-advisor as a solution maker for the end investors. So a lot of education and helping them choosing the right vehicle. So what is relevant for us is definitely the price, so management fees, but also the transaction costs, which can have an impact on the portfolios. And then the quality of replication. So what we do is simply look at very basic statistical measures like tracking error or deviation risks, etc., that will be relevant for us to use this ETF or the other one.
Arnaud, coming from Lyxor, a massive player here in France, do you agree with David's assessment of what the French market needs in terms of ETFs?
Yeah. Now, first of all, for me, really, the services provided by Yomoni, the likes of Yomoni, robo-advisor in Europe, is a great achievement for us. It's a great new product, great new offer. It gives us, for the first time for a long time, a new opportunity to develop the retail market in Europe, which is by far our biggest challenge as an ETF issuer. In Europe, if we don't succeed in increasing the retail market in the coming years, we will collectively fail. So that's exactly the type of service we were expecting to put another dynamic. It's interesting to remember that when we created ETF in Europe, in France, via the PEA, for instance, vehicle in 2001, it was dedicated to retail, actually. We started this business to tackle the retail market, and we ended up by selling ETF to institutional. Now 90% of our clients are institutional. So when we talk about retail, we are talking about two different types of clients. First of all, the self-directed investors that are, by definition in France, a limited population because financial education is not developed enough. But when we go into the second category, which is the people that need advice, I mean, the product like Yomoni gives this kind of advice, professional advice, at a cost that was accessible in the past only by professionals. So first of all, that's a great innovation. It brings, for us as an ETF provider, some challenges, especially on the liquidity on exchange. And I would like to spend a little bit of time because you mentioned that effectively you choose between ETF and index funds. And my challenge is to convince you to use the liquidity on exchange to save some basis points in terms of transaction costs, but we need to make sure that it happens actually. And we have a challenge because the European market is exploded across various exchanges, so the spreads on exchange may be sometimes challenging. We are working hard to improve that. We have as well to improve the mechanics that especially the insurer are using in Europe to buy ETFs. It sounds silly, but the retail distribution network has not been developed to buy product on exchange. They don't know how to do it properly. They buy funds, mutual funds via classical channels, fund channel, but they don't usually use the stock exchange. So our main challenge is probably to make sure that the mechanics between, I would say, the traditional retail wrapper, insurance wrapper, bank wrapper, and the stock exchange, the area of ETF, the connection between those two worlds is done in a proper way. So that comes back to mechanics, and as an ETF provider, we have to provide good solutions into the mechanics. So on top of price, on top of tracking error, we know how to manage that, but in terms of mechanics and linking the worlds, that's another issue.
Yeah, good to have that perspective. And fees, as both of you have mentioned, it's an inescapable part of innovation lately. Christophe, we spoke a little bit about fees. We've had zero fee, we have had negative fee. Is there any possible room left for innovation in fees? What do you think it looks like in the future?
Yes, clearly fees became a really important part of the final performance. That is, the new normal is low interest rate. Real interest rate, nominal interest rate, low productivity, low economic growth. That is, at the end, we have low expected returns. So now, fees are one of the most or really important parts of the final client performance. And this is one of the main reasons of the success of ETFs. That is not only transparency and liquidity. The main reason for me is the level of cost. So what we are observing, maybe, even if just starting, it's maybe no more the traditional dichotomy between active and passive. That is, for our clients, we are proposing some solutions with a mix of passive, active, even passive investment could be active, that is smart beta and factor investing are certainly passive in one way, but they are different from market cap benchmark, so they are active at the end. So we have no more the traditional dichotomy, and I think that active management is ongoing to reduce and shrink fees, and certainly ETF and passive will evolve to propose more and more active solutions. We see, and we saw on the figures that this is only 1 or 2%. We have only 1 or 2% of asset under management with active ETF, But clearly, there is one way to progress, I think, and the performance fees is one important part of this kind of equation. That is, the whole model was, especially in the hedge fund industry, but also in active management, to have management fees plus the performance fees with asymmetric performance fees. But it generates some problems, these asymmetric performance fees. The first one is that it can push some risk-taking. We know that. The main advantage of this asymmetric performance fees was to have some alignment between what wants the final client and the incentive of the portfolio manager. But at the end, it's not so easy and so simple. That is, as a strategy, ETF, and fund selector, we cross a lot of offering with replication of a very poor benchmark. That is, we cross some offering with performance fees, asymmetric performance fees. The company was elaborating their own benchmark, and then they propose a product to replicate and beat the benchmark. At the end, when I studied the benchmark, it was an absolute return benchmark. But at the end, I can replicate it with 20% of cash and 80% of equity. That is very easy to beat. I can add simply 5% of equity. This is a low tracking error, and I can have excess return. So the main, I think, innovation is to have some symmetric performance fees. This is an old system that exists for decades. Some people ask them fulcrum and talk about fulcrum fees or flex fees. But clearly, I think this is one manner to disrupt from the ETF, to disrupt active managers. That is, already ETF has disrupt traditional active management, vanilla active management. But I think the new way is to also disrupt the alternative way. And I think that this kind of symmetric performance fees is one of the most important innovations in the future. And we know that, I finish on that, but typically we have some companies that start to apply this kind of symmetric fees, like AllianceBernstein, Fidelity, but I think this is only the start of this new way to propose fees.
It strikes me that one thing people like about ETFs is that they're predictable and transparent. Would that sacrifice something in terms of people knowing what they're going to pay in an investment if we had variable kind of performance fees? Or
it really depends on the final client, the end client. That is, for retail clients, they don't care so much about transparency and risk management. That is, they only look into performance and compare even benchmark. That is, yes, it's better to have full transparency for risk management, etc., but it's not a request from the final client. They want simplicity. If they want transparency, it's maybe now more on ESG, carbon impact, etc. But they don't care about the full list of positioning every day, usually. For institutional clients, this is slightly different. Clearly, I think that the less transparent ETF are not a promising trend, because for institutional clients, liquidity and transparency every day for risk management, etc., is really, really important.
Why don't we go to our poll question, and I'm going to pose this to the panel as well. So if you could take out your phones one more time, we'd love to hear from all of you in the audience. It's the event app on your phones and the polling section of Future of ETFs .app. And the question we have today is, do you consider AI, artificial intelligence, an innovation in investing or marketing? So is it investing or marketing? Do you consider AI an innovation in investing or marketing? And I'll ask this of the panel. And Hortense, I know we spoke about AI, and you had an opinion on it. So what is that? How important do you think it's going to be in ETF world?
Yeah, well, I mean, I think, what are the results? Marketing? Oh, that's surprising, actually. Really? Well, no, I think we're going to see more AI being used in asset management. I don't know if you can really do it in an index format, but for active management, I think this is definitely something they can use to gather data, make sense of the data. At Morningstar, we're using more and more AI. And the asset managers we're speaking with are also saying they are exploring the use of AI. So I'm actually quite surprised. I don't know what to say. I mean, does that mean that you just need to put AI in the name of a fund to make it a commercial success?
Let me try to jump in maybe. Actually, we are using artificial intelligence is a big word. We are using automation and some kind of technique of artificial intelligence. You're going to be surprised into our marketing stream actually. Why? Because we are talking as an ETF provider, we are talking to hundreds of thousands of clients potentially, from direct retail to institutional. With a bunch of sales and marketers, which is in the region of 20 or 30 people to cover Europe. So by definition, it's impossible to cover this kind of population. So we are using effectively techniques, machine learning techniques to understand better what our clients are interested in, to better assess their needs, to better tackle the right product for their right needs. So I'm sure it was not the expectation you get on this question, but effectively the area where we invest the most in the area of artificial intelligence is our marketing tools. We are not doing ourselves. We are using startups that have developed tools to tackle this issue, how to send the right communication to the right client at the right timing. That's the question we can ask. As an investment, we've seen products last year that has collected massively into robotics, artificial intelligence. That's been a very successful thematic, and I personally truly believe that it will continue. By definition, robotics, artificial intelligence will become in the coming years sectors like oil, like telecom, like banks in itself. The question is how to define this sector. To create a product that tracks properly this sector. And that's the challenge. Obviously, there is no single answer. We are working with various index providers. We are working sometimes with specialists outside the index universe that brings us their expertise into how to define this universe of robotics, artificial intelligence, to try to get a new set of definition to define what is an investment into this area and to create a product. But apart from this, effectively, we are not using on our side artificial intelligence into our investment process by itself.
So it literally is a marketing tool for you at this point. Christophe, coming from a quant background.
Just a few points on this main message from the audience. That is, they are right. As a buy side, the majority of artificial intelligence offering I cross was bullshit. Sorry for this word. But it was not artificial intelligence at all. We practiced artificial intelligence in my department for 1 decade before the world was a buzzword. And I crossed some people like robo-advisor. Behind that, it was an Excel spreadsheet. So not at all intelligence. So we are using artificial intelligence, but for some dedicated part of the investment process. But this is only for specific tasks. I can just explain for clustering to cluster managers. So we have kind of models they are using in submarines to identify whales and other submarines. We have this kind of techniques to identify the right style of the fund manager. We are also using artificial intelligence to have some shadow rating, that is to have some alternative credit rating and not from the main agency. So we have some dedicated applications, but the majority of what I cross was not at all artificial intelligence. And this is a buzzword, and sometimes this is old quant, but quant is always innovative. That is, Now, even quant is no data scientist, artificial intelligence, but quant are using artificial intelligence for more than 2 or 3 decades. So certainly, some of the offering in artificial intelligence is just marketing and just a good reason to have an interest, a buzzword. But there are also some dedicated task and some investment process to improve thanks to this kind of technology. Yeah.
And David, I wanted to ask you, based on your early answer, there is this trend of some ETFs becoming fancier, more complex, more tech-friendly. I mean, do you see much value in AI ETFs, for example, in your line of business?
To be honest, I'm very skeptical about this type of approach. I think that, funnily, it's like passive investment reinventing active investment today, but at a lower cost. So it's very strange, I find. And I mentioned that in my first point, but one reason why we have chosen passive investment and ETFs for our solution for clients is definitely because it's a robust approach in terms of performance. It's a kind of relative risk-free approach when you're talking about the different asset classes. And this is the beauty of passive investment, basically. Just not trying to beat the market, just being extremely precise in execution and in being able to replicate the market, doing that the right way and at a low price is the beauty and the essence of passive investment, and we definitely believe in that. So funnily, what we are seeing today is kind of the passive investment industry becoming active, and generally all the fund management industry just lowering basically the prices. That's what's going on today. So I would say in general I'm quite skeptical about this type of approach. What we are using basically on a daily basis for our clients is plain vanilla ETFs or passive vehicles. This being said, there are some changes that are happening. I think that definitely ESG was mentioned, and this is not, I would say, innovation, but this is a big trend which is happening in Europe. And as a robo-advisor, we can't deny this, so we have to adapt on this request from clients. And there we are working closely with ETF providers who can help us provide the right solutions. So we are kind of intermediary between the end clients and the ETF providers. And then I'm thinking also of innovation in terms of ETF products that can help provide good solution in a very specific environment. For example, for specific tax wrapper in France, we have worked with Lyxor on PEA eligible ETFs that are invested in fixed income, which is kind of innovative, but it's the right way of reducing the risk in a PEA portfolio. It's a kind of very French issue, but this is a kind of very good example of innovation that can bring value to the end client. On the question of identifying the right sectors in the next 20 or 30 years, I think this is mostly like active manager questions, and honestly, I'm not convinced about this type of approach.
Okay.
That's why we're going to work with active managers. That's where the link. We are a provider of infrastructure as an ETF wrapper. So that's probably, I don't really believe that non-transparent ETF or stock picking ETF, but joining our forces with active managers to define universe, to define new sectors makes a lot of sense for me. That's what we're going to see.
Yes, and ETF need to innovate, to propose diversity of products and some heterogeneity. That is, so it was explained during the last panel, that is the market cap market for ETF is already done. And so this is why they are proposing factor investing, smart beta, thematics. But at the end, even factor investing, if you have multi-factor, if you aggregate each factor, at the end, this is very close to the market cap. I can testify of that because we test the idea. Another example, we cross a lot of fixed income factor, multi-factor proposal. After some investigation, they always talking about, okay, we have factor 1, factor 2, factor 3 with different names on the factors, but they forget that the two main factors of the fixed income market is credit risk and duration. That is, they are defining new factors, not only passive but also active manager in this field. So they are defining new factors which are not the traditional factors, and at the end they are proposing some solutions that beat the traditional benchmark, but at the end with more credit risk.
Of course, yeah.
So that is, ETF need to innovate because at the end this is very close to market cap, even when they try to diversify. And you have some academic papers, and the IMF and some regulators are very attentive to that. Some academic papers that demonstrate that thanks to the ETF liquidity on market cap, the share of ETF will lead to a more pronounced global financial cycle. Think about emerging market a few years ago with the taper tantrum. That is thanks to the liquidity they provide. This is very easy now to sell or to buy based on one news. So probably they have to innovate to propose some diversification, so new paradigms like factor investing, but with more diversifications, because just to stop on the factor investing, that is, there is a big difference between factor investing in academics and what we find in the ETF industry. In academics, the factors are not so much correlated because this is long-short factors. But in the industry, all the factor investing is long portfolio. That is, they embarked a beta component which is close to 1. That is, at the end, if you have a value, growth, risk parity, etc., you aggregate that, you have a beta close to 1, and the diversification is poor. Yeah. So I think the new way to innovate is maybe to propose some diversification, to not propose with a new name a market cap or close to market cap solution.
Why don't we tackle one last question? I want to step out a little bit and think more broadly about the asset management industry. Is there a time when an Amazon or a Google is going to come into the asset management industry and launch a product? Hortense, we talked about, you talked about the importance of asset management firms becoming more tech firms today. Can you explain what you mean by that?
Yes, I mean, it's, we talked about innovation, when it comes to strategies, but also asset managers will have to think more in terms of solutions, and they will have to use technology for that. They will have to really focus on the customer for every strategic decision they make. I mean, you have a player like BlackRock, which is the largest asset manager in the world, who said that the focus for them is really technology. They want like a third of their revenues to come from technology within 2 or 3 years. The people they are hiring are people who have computer sciences degree, psychology degree, because it's very important to understand investor behavior. So we're talking about products as well. But, I mean, this is very important as well, of course, but at the end of the day, what investors need is more coaching, and this is why advisors have a very important role to play. Even for robo-advisors, I mean, they use nudge techniques, to prevent investors to kind of shooting themselves in the foot, because investors are the worst enemy. They want to sell when it's not the right time to sell, or buy when it's not the right time to buy. And so with the use of technology, we can really improve investor experience and deliver better outcome as an industry. So it's not, the industry is not only about coming up with a new strategy. It's also about thinking about solutions and try to help the investor in a different way. It's not only about risk performance, and this is why I think ESG has the power to change the way investing is done. First of all, by deepening and widening the investor pool, but also by making it more meaningful and helping investors really be more engaged in what they're doing and avoiding making mistakes along the way.
Okay, thanks.
So,
Maybe-
yeah.
Arnaud, I'll give you the last word briefly.
Now, where I see a potential technology disruption, maybe you're going to talk about it next year, is in the area of the can we use the blockchain technology to reduce again the costs of our ETFs? What I mean is the post-trade mechanism in Europe or in the world for ETF trading is still based on pretty old techniques. The use of CSDs, the use of custodians, etc. It's pretty costly. If we find a way, or if someone find a way to reduce again the cost of our ETFs by using the blockchain technology and disrupting the post-trade actors I mentioned, there is a potential effectively added value for our clients. Not easy. We are in France, Lyxor, with a bunch of asset managers have invested in a startup called Isness, which is working on using the blockchain technology to replace the classical registrar technology, so to become a registrar on the blockchain. Are we gonna be quick enough versus potential big technology guys coming in? I don't know, but we are working on it, and we'll probably have some news next year for the conference.
Okay.
Hopefully.
Certainly a topic to pick up next year then. Thank you very much to our panelists. Please join me in